Good afternoon, all. Steve Parisi here with IBC Global. Hope your day is off to a fascinating and fantastic start. Today, we've got a good friend, agent here at IBC Global, Scott.transue. Scott, how you doing, my friend?
I am doing great.
Nice. You are looking sharp today in that suit.
Thank you.
Gosh.
And you too.
Oh, why? Thank you. I like the Clark Kent look you got with the glasses. Usually, you don't have them on, so it's like the Superman.
That's why I put it on there, just to make you that
I
look.
got
Look.
Gotcha. Well, thank you for your time. I know you guys are always going a mile a minute, speaking with individuals interested in policies and educating them on I want to say daily basis, but on an hourly basis, I feel like, since it's nonstop. But what I want to talk about today is, just a recent story with someone you had recently worked with that took a policy out with you, but kind of his initial process, like when you first connected with him. I know you and I worked this particular case together. He was educated. He has a heavy real estate background. He's got a day job as well, very successful from a monetary standpoint at a very young age. But as he continued to learn more, he identified some things just in working with you that he said, hey, what I have, I think it can be better. And you were very patient with him throughout the process and just kind of educating him on how it worked. So that's what I wanted to talk about today.
Okay.
All right, cool. So the individual, we won't mention any names, obviously, when he first connected with you, he was a real estate investor, but when you guys first connected, what kind of happened there? He was interested in a cash value life insurance policy, or was he just interested in more information?
Yeah, he was interested in a high cash value, whole life policy. I mean, he knew his stuff. Um, he did want to see illustrations on how we designed it,
Yeah.
because I don't think he thought in his mind that it was optimized as best as it could be.
hmm
Um, so he wanted to see, I guess, comparisons kind of
Got,
thing.
gotcha. Quick question. So when you say he thought it was optimized the best it could be already, do you mean the policy he already had purchased from someone else?
Yeah, from someone else.
Okay, gotcha. Gotcha. Okay. So you connected and he wanted to see just some things to compare more or less.
Right. And
Got it.
so we had discussions a number of times, and then we ran the samples. I sent them to him, and he liked what he saw,
Yeah.
especially at the expense costs
hmm
compared to what's going into your cash value.
Gotcha. When you say expense cost, was he kind of looking at the break even to say, okay, I'm paying the same dollar amount in, but I'm seeing a difference here?
Yeah, and he in our design, it was more of a break even point in that 4 to 5 year period, whereas the other one wasn't breaking even way further down the line. He was paying more expenses, more money was going into his expenses, whether and less going into his cash value, or
Gotcha.
zero was going into his cash value.
Yeah, and I can kind of go through the details too, because I know a lot of our audience and people you work with like the details and specifics there. So the options you showed with the same out of pocket in one instance was breaking even 4 to 5 years.
Yes.
So your client's putting in a dollar, and by year four, he's paid in $4, and he has $4 in cash value, or more than that.
Right.
Compared to the other option, where it's the same out of pocket, but when he actually had more money in the policy, his break even was around 12 years or so.
Yeah.
Yeah. And then we looked at the guarantees, but it was much more extended. So this really speaks to the situation where someone looks at a policy and he did say to you, hey, I think it's optimized. I'm pretty well set, but I would like to see a comparison. You see a big difference there where same out of pocket for the client, but a significantly greater cash value upfront and greater values long term with your option. If I'm him, my question would be, okay, like, why is there such a difference here? So when you got that question, how do you handle that appropriately?
Well, appropriately, it depends on the company you go with
hmm
and how it's designed.
Yeah.
So when we design a policy, try to minimize that expense as low as we can. And generally it is around that 10% of whatever he's putting in. So he's putting 100,000 in, his expenses should be in that $10,000 range.
Right.
And he saw that in the design of our design, where there was 10% only going into expenses, where and the cash value was pretty good in the beginning. And that's where it broke even a lot quicker.
Gotcha.
Where he was basically putting all his money in the first year. He had a lump sum, and then most of it was going toward expenses, and then a little bit was going toward cash value.
Yeah, and I recall that. So basically, I mean, overall, you just minimize the premium with that typical 1090 split because in his situation, that worked really well. He was funding for a short period of time too. I recall his exact numbers too. I mean, what he had was a policy where in the first year he was paying in 125 grand. So lump sum right off the bat. But when you actually broke down the design of this policy and where his money was going, we saw that the base premium piece, the insurance expense, which nothing shows up in cash value in the first year, was about 75 grand. So how it was structured was with a $75,000 insurance premium that translates zero in cash value in the first year. And then another 50 grand was just dumped into PUAs. But then each year thereafter, from year 2 onward, the ongoing payment was 75,000 per year. So it was all base premium from that point forward. So that case in particular, with a design like that, where if I have an initial PUA payment, but nothing going into PUAs thereafter, that is precisely where individuals run into situations where they look at it and say, okay, like, why is it just taking so long for me to see any real value here? Especially for him, which we'll get to next, where he's a real estate investor and he could use that capital to continue to grow his portfolio.
Right. And that's what he pointed out in that first year. He saw all that cash value, 85 to 87% of it in
Yeah.
that first year, where the other one was zero.
Yeah. I mean, he had the 50K lump sum, but yeah, I know what you mean of the premium. Yeah. Yeah. And that's, a traditional case of whole life insurance as well. And nothing ever against any agents or anything like that, because there's a million ways to design policies. And in that particular case, I mean, that could be an agent that's just designing it comfortable with a particular design, particular company. There's a million things that go into policy design and company selection. But back to the client's objective here, he wanted to pay a certain dollar amount in, and he was interested in real estate investing.
Right.
I remember when I talked to him at one point, I think this was after he had opened the policy or right before, he had actually discovered high cash value life insurance from research around real estate investing. So he's a real estate investor, and what he had done is seek out a mentor or a real estate coach who said, hey, here's what I do with my money. I float through a cash value life insurance policy, made an introduction to someone else, and then he was told, hey, this is how we set up policies. This is how real estate investors structure these and the kind of money they pay in and how they use them. And he looked at it and said, all right, I mean, if this is the way that it's being done, then it's got to be in my best interest, especially if the real estate coach does it.
Right.
But then in talking to you, he saw, okay, I can still do the exact same thing with the real estate that I was taught, but now I can put the same amount of money in and just have a significantly greater amount of value in my policy, which gives him more working capital, if you want to call it that.
Right.
Mm-hmm.
That's what he wanted to do.
Gotcha. Gotcha. Anything, I know I talked a lot there. Anything you like to layer on top of it?
No, you kind of wrapped everything up. I mean, that's what he wanted to use it for, the real estate, basically.
Yeah.
And I know with those guys, the real estate investors, they need a lot of money up front so they can use that, so they can purchase another investment account or a property that they need, and then they can put it right back into the policy where it can still collect that dividend, whether you take it out or not.
Yeah. Mm-hmm. Yeah. And I mean, with real estate investors and this individual too, I mean, working with him, a cash value life insurance policy is often viewed as a nice area to store excess cash if I have money in the bank, for example. But how many people do you work with that open these policies and say, this is like where I'm making all my money because the returns are fantastic. I'm going to put as much as I can just to let it sit and grow. How many people do you get that want a cash value life insurance for that policy for that reason?
For instance, just to sit and grow.
Yeah.
Hardly none.
Yeah. None.
Basically.
Yeah. Or a small percentage.
Yeah, there's that small percentage that people do that, but they use the policy so they can use it.
Correct. Yeah. So for example, this individual that you're working with, he does really well in real estate. That's where he makes his money. And really the value he saw with the cash value insurance product was, okay, I've got money in cash doing nothing for me. Here's an alternative that'll actually grow, safe, liquid, tax-free, all that good stuff. And now when deals come, I have access to my cash value in the policy to continue to acquire real estate. And it's always compounding the money in a policy with no lost opportunity cost, all that good stuff.
Right. And that's what attracted it to him is there's no lost opportunity. You put the money in there, let it grow. You take it out, it still collects that dividend.
Correct. Now, did he have a question on the non-direct and direct recognition treatment when you were talking to him?
He did. He did. I mean, he really wanted to know if there was a big disadvantage or advantage to either one of that direct or non-direct recognition. Yeah. And I just showed him it was just how the different companies would provide the dividends for that money that you take out.
Gotcha.
And he was all right with that.
Yeah. I remember he went with a direct recognition company. If you want to kind of explain an overview there, like how does that work? So pretend I'm him. I say, hey, how's the direct recognition actually work? Because I heard it was bad. So how does Guardian's direct recognition work? To use a specific example with an insurance company, how does that work? And just for this example, if you want to pretend that you've got $100,000 in cash value and I loan out $50,000.
All right. So I would go, good question, Justin. Or Steve.
Gotcha.
If you take that 100,000 and you take 50 of it out, that 50 that you leave in the pot, you're still collecting a dividend of 5.65.
Okay.
However, the money that you take out, you're still collecting a dividend. But what Guardian does is bump up the dividend to 6% to wash out the effect the interest that they charge you. And when you repay it, it gets restored to where it would have been, as if you never touched it. And a little bit more because of their dividend rate when they bump up the borrowed money.
Got it. Okay, so I'm pretending I'm him again. So if I've got $100,000 in cash value, I'm going to repeat it back to you because I think he does that a lot of times just to help with. Yeah,
he did.
Yeah, I'm going to repeat it back to you, Scott. So if I've got $100,000 in cash value and the dividend rate's 5.65%, and I decide to loan out half of it, the $50,000 that I still have in cash value gets the same dividend rate of 5.65%.
Yes.
Okay, perfect. And then the money I've borrowed out, the company charges me a 6% cost to borrow. That's the loan interest rate. But with the dividend rate, they bump that up to 6%?
Yes, they do.
Gotcha. So then when I pay it back, like what you said, I see everything restored and a little bit more because I had a higher dividend rate.
Right.
Okay. Gotcha. Oh, that makes sense.
Yeah. So, but he was all right with that. And, and he that's what he does is he's borrowing his money.
Gotcha.
Always working for him.
Yeah.
Other than a savings account where if you had it in a savings account, you're only getting a 0.1% or whatever they charge you for that. Correct.
Got it. And now he's using his policy quite a bit where he set it up to be very flexible, correct?
Yes. Mm-hmm. That's what I like, the flexibility of Guardian over some of the other companies.
Yeah, where he can commit to a smaller amount and just add more when his cash flow says, okay, you can add more to the policy.
Right.
Yeah, got it. Okay, nice. Well, thanks for going into that story. Anything else that you'd like to add on that one?
No, it was a joy to work with him. It was just, encouraging that he, had all those questions and we were able to help him out, get a policy that really worked for him, what his needs were.
Yeah.
And that's our goal, really, is
Yeah.
to help clients fulfill their needs,
Yeah.
so they can use it.
Got it. Got it. One thing actually, thanks for mentioning that I wanted to touch on is something that you had done before just saying, hey, let's just open up a new policy and roll everything into it. Is the first thing that we did actually was looked at his existing policy and said, hey, before you look to make any moves with a new policy, you might be able to go to this company and make changes to salvage more of what you've paid in.
Right.
So here's exactly what you want to do, where we typed out an email for him to say, hey, send this to the insurance carrier. Say, I'd like to redesign my policy, lower my base premium, make sure it doesn't mix. So as if he has the knowledge that an agent does, and then go to the company and try and restructure it, because you can do that with companies. A lot of people aren't aware of it. But in that process, when he tried to do it, he was quickly just called and, told, hey, you can't do that, or you shouldn't do that. Just ran into a ton of resistance there.
Right.
Yeah. But
Yeah, it's it's the right thing to do. It's you don't want to have him lose some of the money that you put into the existing policy you had.
no.
But if they're not, sometimes they're not willing to work with you or say they can't do it. Sometimes it's best to look at your own interest.
Correct. Yeah. I mean, it's like if you've got, if your car breaks down, you get a flat tire or something like that, are you just going to scrap it and go get a new car? Like,
You're gonna fix it.
yeah, no, I mean, if you flew off a ditch and flew into a ditch and you've got a flat tire and there's several other things wrong with it, and the mechanic says, we can't fix it. You go to another mechanic for a second opinion, you can't fix it. Nothing's there. Then you swap it and go into a new car. But otherwise it's like, nah, I'm going to try and fix it first because it's going to save me a ton of money.
Yeah, oh yeah.
Yeah,
Yeah,
definitely.
that's with life insurance in policies. I mean, it's like we get a lot of people who have maybe out 20, 30 years and they want to replace it with a new one. It's already working for you. So no sense of changing them.
Yeah, very frequently we'll do that. Just let them know to keep the same policy because it makes sense to do that. I mean, if that was us, just knowing how policies work, we want to keep it in force. So do the same thing for another individual.
Right.
Great. Well, thank you so much for your time, my friend. Really appreciate it.
Thank you for having me.
Absolutely. Absolutely. The pleasure is mine. If anyone has questions or would like to reach out to Scott, we've got his contact info below. Feel free to reach out anytime. And until next time, my friend, I'll talk to you soon.
All right.
All right. Enjoy. Thank you. All right. Bye. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.